Hi, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about the best annuities to avoid market downturns. So if you're worried about the market going down and dragging all of your earnings down with it, and you're thinking, I'd like to have some growth, but I'd like to have market protection, then you're going to love this video because I'm going to show you all the best annuities right now that will give you just that. Okay. So annuities can be complex, but I try to keep them as simple as possible because really what you're looking at is a contract between you and the insurance carrier. And there are some great rates right now because interest rates are great. So let's take a look at this. I'm going to show you first the MIGA options. And these are multi-year guaranteed annuities. They're like CDs. They're given higher rates than CDs, but they're the annuities version of a CD. And they provide a lot of benefits, especially if it's non-qualified funds. You could put non-qualified funds, which are cash or brokerage money, not IRA or Roth or anything like that. But you can put non-qualified funds in and they still grow tax-deferred, whereas with a CD, they don't. Okay. All right. So let's take a look. We've got 2-year options, 3, and just so on. So it keeps going and you'll see, all right, 6-year. And this, well, look, we even got a 20-year. So 20-year is not available for every state. What state is this? It's Oklahoma. So Oklahoma has some options. And I'm just, saying, hey, this is an IRA or Roth. I mean, it could be any funding. The rates are the same. Okay. Put 500 grand in here. I would recommend putting at least 100,000 in. If you put less than that, then you're going to have a much lower rate. Okay. So let's take a look at this and we'll say, if we're looking for the highest rate, which ones are usually paying the most? Well, usually with a MYGA, which another name for them is just a fixed annuity, is they are paying, from my experience, the highest rates are either a 5, a 7, or a 10-year. Now with these, and I'm going to show you other options after this, okay? But if you want to protect your money against market risk and you want a certain rate for a certain term, these are great for that. I can show you some other options that'll give you income for life that are great. They protect your money against market risk, and you can put your money into a fixed index annuity that has a good index, a good company, good renewal rates, and have decent growth rate, but it's hypothetical. What we're looking at here is guaranteed. Okay. So 5 years, and this is showing the top 3. If you go to my website, johnstevenson.com, it's going to show you hundreds. Okay. So if you want to look at those, you can go to my website, johnstevenson.com, use my annuity calculators. And then if you're looking to buy an annuity, you can book a call with me right there. So, all right. So let's take a look at the 5-year. 5-year paying 6.25. That's pretty darn good. Wichita National. Then you've got Mountain Life, and you got Exonic. And then you've got several others that aren't being shown, but this is just showing the top 3. Now, some of these provide withdrawal options. Wichita does not allow any withdrawals. With Mountain Life, they allow 5% after the first year, and then Exonic allows 10% after the first year. There are ones that will offer you withdrawals in the first year. They just give you a lower rate. So there's a trade-off. So if we're looking at this, though, let's see the 5-year. Let's see if we want the most growth possible. What does it look like? Well, 500 grand is going to earn $31,250 in the first year, and then it's going to compound. You got a higher amount now, 531, earning the same 6.25, and so on. So over time, over 5 years, it's going to compound of $177,000 in total earnings. So you got $677,000 at the end of that 5-year. Pretty good. Okay. Now let's go here, and we will talk about the 7-year. Look at that. Wichita is on the highest one as well, followed by Exonic and Revol 1. Let's look at Revol 1 because Exonic's not showing me an illustrator right now. All right. So looking at that, 7 years, 244 grand. It's not bad for 7 years. You got 744 at the end of that. Okay. Let's look at the 10-year. Go down here. Wichita, Revol 1. Wow, what great rates. This is crazy. $899,000 ending value. Look at that growth. Guaranteed. $399,000. You got almost 900 grand in total earnings. Wow. And that's guaranteed. That's protected against market risk. It's not in the market. They're just giving you high growth rate because of the interest rate environment. Then you got the safety backing of the insurance company. So if you want to spread it out over a couple of different companies, you can do that as well. pretty nice. These are great if you're looking to protect 100% against market risk and you want to be able to have guaranteed growth. And then, of course, some of these will allow you to take out interest payments or even more. So if you want to do that and live off some of the interest over those years and kind of do a bond laddering strategy, this is great. People will do that. So, but let's look at lifetime income. Okay, so lifetime income, you can also have market protection, but your account balance is going to go down. Okay, so it's designed for market protection because it's a fixed index annuity, but it has an income rider attached. And I'm going to show you one without an income rider attached, just so you can see the no fee option, but it doesn't give you lifetime income. So if I threw this in here and I was like, well, I'm going to just push this out as far as I can. Let's say this is an IRA. Okay, so I rolled it over from a 401k into an IRA, and I bought an annuity contract, and I deferred it as long as I could. So maybe my RMD age is 73. I know I have to satisfy RMDs at that age, and so I decide to wait that long. So, and I'm married, my spouse is 60, and we want joint income, and we want market protection. So we look at that and say, okay, well, how much income will that give us? Okay, so in this scenario, it's $86,877. So it's pretty good. That's with ClearSpring. And you can see there's lots of other options below that, but ClearSpring is the highest. And so we're looking at that. Here's what they're giving us. They're giving us a benefit-based growth that's guaranteed, grows to almost 1.2 million. And actually it does grows to 1.259, and then multiplies against 6.9%, giving us the 86,877. We want to take income earlier, we can. You can see, if we wait 5 years, it's 50 grand. So, and so on. So it's great to be able to see what it would be if you decided to take it earlier. But it gives you 100% market protection, because you notice here it shows all zeros. That's showing worst case scenario. If there is no market growth and it's just all down, 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 then you're not going to participate in any of those losses. But you're probably wondering, well, why is my account value going down? Right? It's because you have an income rider attached. Okay. If you don't want the income rider, then don't put the income rider on there. So you can see the rider charge right here. Okay. They're charging you, but they're going to give you a ton of income. And then that rider charge goes away eventually because your account balance is going to go away. But the income is there, and that is why you bought it. So when you take that income out, it's like $2 million. That's really, really good. Okay. If you live longer than 95, you're going to take out more. So let's look at the ones without riders. Let's say you're just like, well, I just want to have market protection, but I want growth in the index. Can I do that? Yes, you can. So they're not going to give you all of the index, because remember, these are tied to the market, but they're tied to a call option. So these insurance companies are buying call options associated with certain indexes, and there's a lot of indexes out there. If you notice here, there's like 3,800 just on this page alone. Okay. So you're thinking, oh my goodness, how am I ever going to pick? Well, I'll just tell you right now, if you're working with an annuity expert that does this 24/7, you're going to have the best options, because I know how to sift through all of these and tell you which ones to get. There's a lot of fancy indexes out there, and they're all back tested and they all look great, but a lot of them will not perform. Most of them will not perform the way they're illustrated. And a lot of guys will not tell you this, and they'll just illustrate them and they'll look great and they'll sell them to you so they can make these huge commissions. I hate that. Okay, so if you're going to buy an indexed annuity without income rider, just bare bones, you want market protection and you want growth in the index, I'm going to show you the best ones. And so one of the best ones is Delaware. Lincoln Financial, National Life Group, and a few others are really, really good for index growth. But I'm going to show you Delaware in particular. Okay, so Delaware, they are a company that is known to keep their renewal rates high year after year. You might be wondering what that is. And I'm going to show you the S&P 500, not any other index, because the S&P 500 is real and they're going to actually get real returns versus some of these other fancy indexes that may get returns, but most of the time don't. So what they're doing, though, is they're giving you 60%. And you might be thinking, well, that's not very much. Well, yeah, you're not getting 100% of the market, but there's a cost to protecting, okay? The cost is real because they're buying call options that they may not exercise, okay? There are a couple of years where they cannot exercise them because the market's down, and they might have spent $1 billion on those. So because of that, there are years when the market is up, they do exercise it, and they make a profit, and they give you a portion of it, not all of it. That's why you get 60%. But you get 100% protection from the market because you're not in the market, but you get to benefit from it. Okay. So if I was to sell you one of these, I would say pick Delaware. or Lincoln Financial. Lincoln Financial has a similar participation rate for the S&P. You got the other ones, Global Atlantic, National Life Group. They're good. They keep their caps high, but caps are different than participation rates. Caps just cap the amount that you can make. Okay, if it earns 20%, you're capped at 10, you're going to make 10. If it's capped at 10 and the market does 8, you're going to get 8. They're just capping the amount that you can get. Okay, with a participation rate, they give you the entire index subject to the participation rate. So there are years where the S&P does really, really well, and 60% is a whole lot better than being capped at 10. Okay, so let me show you that. So we're going to illustrate this, and we'll say we put in same amount, $500,000, and they show you guaranteed values. Guaranteed values is, as well, if the market does nothing, your account balance doesn't change, because remember, there's no fees. There's no income rider. This isn't for income, even though you can strip off the interest and you can take withdrawals out of this if you want to for income, and people do, but it's not a lifetime guaranteed contract. Okay, it's just protecting your money against market and giving you some of the gains. So, but the death benefit does go up over time just for keeping your money there. So does a cash surrender value if you surrender the contract. So that's kind of nice. It's just kind of a thank you for leaving your money there. But this is a worst case. I don't ever see this happen. Okay. And even the contract value goes up to like 600 grand guaranteed after 10 years. So they make it a no risk option, and they make sure that you still make money from leaving it there. But again, this is with zero interest earned. Okay. Now let's look at what it actually has done. Here is the growth rate. And over time, if you look at this, it's like an 8.771. That's not bad. The stock market's averaged what? 10.5 over the last 100 years? That's really good. So yeah, you're not averaging the stock market return. It's lower, but you're getting a ton of growth, and you're getting protection, because you see, there are years where you don't make anything and your account balance just sits there. Beginning contract value, 590, ending contract value, 590, because the market was down and you didn't get to participate in any of the losses, right? But then the next year it went up. Wow, that's pretty good. 590 to 692. Not bad. You had a few good years, and then not so good of a year. So it just stayed there. 882, ending balance, 882. But at least you're protecting it, and it just keeps on growing. And so that is a great way to protect and grow. And of course, you can see everything goes up. Your death benefit obviously is the account value. In fact, actually, it looks like, yeah, it is the account value. All right, just want to make sure. So, but it's pretty substantial. I mean, you could really grow this thing, and we're being pretty conservative on these numbers. I mean, I could show you some values that'll just knock your socks off, but they'll never happen, because I can, they're from a new index, and it looks pretty fancy, and they're showing you 300% participation rates, but they can do that because the cost of the options are like zero, and there's no volatility with the index, and so the chances of it ever doing anything is probably zero as well. And so that's why a lot of people will buy these, and they're like super frustrated. Like, why did he sell me this? I'm like, well, the commissions were pretty high. I don't know. I hate to pass judgment, but a lot of times that's what guys do. And they don't really know what they're selling a lot of times as well. And so that can be another factor. So anyways, I hope this helps. I just wanted to kind of show you, here is how you protect your money against market risk. Here's how you get the growth at the same time. You're never going to get as much growth as if you just leave it in the market. Okay. If you want the full market growth, then leave your money in the market. Okay. But if you want growth and protection, there's a cost to it, but there's a right way to do it. And with annuities, you can do it with absolutes, with the MYGAs, or you can do it with hypotheticals, but still get some of the market growth with the fixed index annuity. With an income rider, you could just say, you know what, I want market protection, but I really just want income. I want lifetime income. Okay, with that, you need to attach an income rider. There's a cost to it, but it's worth it in my opinion. I mean, if you pay $100 grand in fees, but you get an extra $500 grand in income from that, who cares? Because those fees are coming directly from the account value. They're not coming from the income. The income is a standalone benefit to you. So anyways, I'm happy to help you. If you are looking for an annuity you want to purchase, there is a link below this video. You can go to my calendar and we'll get on a Zoom call. Otherwise, you can go to my website, johnstevenson.com. You can play with my annuity calculators there, and you can book a call there. So, and we'll chat. I'll answer your questions. I'd love to help you if that's what you're looking for, but I won't try to hard sell you on anything. Really, I'm there to serve, and of course, I'd love to help you if that's something that you end up doing. So anyways, hope this helps. If you like the video, make sure you click the like and subscribe button. If you have questions, comment below. I am here to help. So thanks again, and we'll see you next time.